starting with the session for today. We are delighted to have three eminent panelists with us. One who has invested in ventures based on valuation, one who is an expert in valuation, and one whose venture went through the process. So I'm very pleased today to introduce our speakers and panelists. Dr. Savan Godiawala, partner with financial advisory at Deloitte, India, and also a visiting faculty at Ahmedabad. He's a chartered accountant and a qualified insolvency professional too. Mr. Kaushal Mehta, Vice President and General Manager, India at TTEC. He earlier built Motif Inc, which is probably needs no introduction to people of Gujarat at least, employing 3,000 plus employees. It became a 100% subsidiary of TTEC in June last year after it went through the process of its valuation. Mr. Dharmesh Gathani, a partner, Harsh Nirman Group. He has multiple ventures besides being an investor who has invested in many startups till date. So we are also pleased to welcome the presidents of the three TIE chapters who will be moderating the session today. So let's begin with the first part of it. Mr. Dharmesh Gathani will be in conversation with Mr. Saurabh Mehta, TIE Ahmedabad president. With this, over to you, Saurabh bhai.
Unmute, sir.
Good afternoon, everybody. It is my pleasure to welcome you all to this session. This is a very, very interesting session which we put together looking at the start of valuation, because just having a valuation, but we are getting some perspectives from people who have actually been there and done that. So we have one person who is investing in 30 or 40 kind of startups. We have another person who is a valuation professional, who is a professionally values companies. And we have a third gentleman who actually has sold his company. Pardon?
No, I don't want to do that.
Hello? Am I good? Is that for me or somebody else?
No,
anyway, so we have a third person who has created a value on his company and a valuation on his company. And so all three of us will, all three of these speakers will give us a complete 360 degrees perspective on the valuation. I'll start, it's my duty. I'll start with Dharmesh bhai. Dharmesh bhai is an investor. According to, I've been talking to him, he spends around 270 days working with his investee companies. So he has a very good understanding of where to invest, how to invest. He's invested in about 30 companies. So to start with, Dharmesh bhai, let me ask you the first question. How do you invest in companies? What goes into, why would you put the money in a company? I come to you with a startup. Why would you put the money? How would you value my company? Is some kind of AI or some kind of system or some kind of, whatever?
Good afternoon, all. First and foremost, the AIs are we ourselves. We are the ones who are the AI for the startups, because the startups do not have any kind of valuations which you can make directly with them. It is not like a normal traditional way of valuation, like you see the EBITDA or the PE or the cash flows, discounted cash flows and all that. So to value the startups, normally there are different kind of parameters which we take into account. You can call it like it's a very common term, or it's a cricket season, so you can call it a scoreboard, where you have different parameters and then you give the parameters weightage. On the basis of those weightages, you value a startup to make it easy, or those parameters will help you to gauge the valuation of a startup.
Okay, so I understand, you have the parameters and all, but sometimes you just invest on certain things which you told me gut feeling, right? And understanding of the business, a gut feeling or whatever it is. Whatever you call it, but there is this thing I want to invest. So what are those parameters where, you get this, this is a great company. Okay, it's not making money, or it's just starting out, and I can put money in it.
Okay. So normally in startups, you have stages of valuation, the stages of funding. So the funding, the seed capital funding or the angel funding are the first two rounds of a startup fundamentally. And the parameters what we consider in investing are the sector specific, which sectors they deal in, what is the problem they are addressing, or what is the pain point in the market that which they are addressing, what is the total market values which are there, who are the founders, what is the background, how good the founders are, means have they done any startup business before, is their second company or the first company, and again how much dilution they are doing over a period of time, what are the cap tables and the other investors and all that. Basis on all these parameters, that will help us to gauge the valuation and the startup, and then with all this detail what we have and the scoreboard what we make, and the intuition and the art of judgment, we use our judgment. Like normally, if you are of the same domain, that will help you to actually gauge the idea of a founder in the startup, to gauge that is the business model perfect, is it scalable, or is he going in the right way, is the pain point perfect. So this all points will actually help you. So majorly the domain, if you are working with the same domain, that helps you very much. Like for a person like you, if you are doing something in fintech, that will help you very much, considering me if I'm not a fintech guy. So these are the parameters we take into consideration, and then with the help of our friends and colleagues and other people who are in the startup business, or our investors in startup, we talk to each other, and then we get a wholesome idea of the company, and on that basis we arrive at a valuation, and then we invest.
Correct. Now, can you give us an example where you felt that, boss, this company is really good and I just want to invest in it, and some kind of example where, you put some of the parameters aside and just went straight with your gut, or, you just felt that this was a great company?
Recently, last around 8 to 9 months back, we invested in a company called Finance PR. The company came to us. The model of the company was very simple, that whatever school fees the parents pay, we are going to give you 0%, 11 installments of the school fees. So the parent will get an 11 installments of school fees without any interest. So then we went back to him, and then we said, what is the business model? Then he said that we are taking a discount from the school at the rate of 9% on the total fees, and on that basis we are giving 0% interest. And then we said, okay, that is fine, we understand that. That means it's a backward, you are getting 9% on it. Then we said, where do we get the money from? So he said that we take the money from the NBFC at 16%. So then we were confused. At 16%, he is taking the money and giving it to the school, and the school is giving him 9%. How does he make money out of it? Then he showed us a calculation that going backwards on a installment basis, on the 11 installment, he's making 25% on it. And out of it, he's paying 16, and his net benefit is around 8 to 9%. It immediately clicked us. At that time, the company did not have much of business. They had done the piloting around 40 crores of business in 50 schools. And they clicked immediately to us, and we invested in that company. In 8 months' time, in this COVID period with no schools working, this company has now have an affiliation with 2,250 schools. The founders did so much of business. They are now affiliated with 2,200 schools. And with schools opening this year, they are targeting more than 1,000 crores of disbursement as loans to the parents.
Great.
So this is how, at the time of COVID, we were not sure that if we are investing in this company, was it a right investment or not. We only saw the margins and the way he worked, and the enthusiasm of the founder. The founder had full knowledge of what domain he was working on. So that made us invest in that company in a minute. Like we took a very fast decision because time was very short at that time.
And lastly, thank you, Dharmesh. Lastly,
yeah.
What would be the advice you would give to a young startup or a guy coming in and says, I have, what would you tell him, how he should look at his valuation? How should he value his company? Or what advice would you give for valuation of his company?
Normally, valuation and dilution are always in proportion to each other. So two major things what we founder of a startup should know is how much he is diluting, what is the amount he needs, and at every level, is he able to raise money every now and then over a period of time, whatever money is it. So the dilution should not be so much on the basis of valuation what he does today, that he is in a fix on a later day. That he doesn't have if tomorrow he needs money, he is not in a position to dilute further. So The main thing is whatever valuations he makes and whatever funding he gets from that valuation, that should be enough for the runway and the milestones which he sets for himself. And he achieves the milestones and that can keep on getting funding again on a better valuation over a period of time. That is how we should look at it.
Thank you, Dharmesh bhai. I think that this is great. We have basically, I mean, we are out of time on this one, and I think I'll hand over to Savan, and I think Ranjana is taking, or Nitin is taking Savan, right? So one of those, yeah. So I think who's next, Piali?
Yes, right? Over to Nidhi. She will take it forward.
Yeah. Okay, Nidhi.
So thank you so much, Mr. Saurabh Mehta, and thank you so much, Mr. Dharmesh Gathani, for sharing the deep dive insight on investors' perspective on, how they do this startup valuation, and even your own experience and the parameters which you use while doing while you are investing in the startups. So with that, now we have reached to the second part of today's session. So now I invite our next speaker, Dr. Savan Godiawala, and moderator Nitin Sachdeva for a discussion and conversation in understanding the viewpoint valuation process for a venture, or the valuation process should be done by the ventures and more. So over to you, Mr. Nitin Sachdeva.
Thank you so much, Nidhi. Welcome, Dr. Savan. It's a privilege to be here on this forum with you, where there are so many chartered accountants and so many learned speakers here. We understood how to identify the startups. Now we will go through the questions which are related to the valuation aspects of the startups. And as TIE India Angel has also been launched, so we as charter members at TIE would be investing in a lot of startups wherein we need to learn the complexities of the game basically before diving into it. So to start with Dr. Savan, what are the different valuation methods for startup valuation, and are there any matrices that are used? Can you share some insights about it?
Thanks Nitin, thanks Nidhi. Of course, thanks Saurabh bhai, Piali, Dharmesh bhai, Kaushal bhai. So pleasure to be here. And of course, Nitin, your question, and this was a standard question naturally, which has to come with what are the valuation methods? And honestly speaking, there is nothing like a valuation method. These are more about academics. What Dharmesh bhai mentioned is the method. There is AI within yourself, right? So that's what he said. And so of course, I would certainly not avoid your question. I will try to communicate what generally the investors look at from the methodology point of view. But at a startup stage, that gut feel is so very important, more than any method you put it. Most of the startups are either at a drawing board or at a pilot or just a prototype stage, or maybe just looking at where the commercialization will happen. When we talk about startup, and of course there are few of them who are already in the market, but that's not that's few and far between. So having said that, Dharmesh bhai mentioned something very, very relevant. He said scoreboard. Now, scoreboard is something, if you would have not been the speaker before me, I would have probably not realized that scoreboard, but scoreboard is such an important thing where you try to assess and put that what is the company about? Is the market in place? Is the team in place? Is the prototype in place? Is the readiness so far as going further and doing the research or is in place, or is it the idea in place? So one is the stage, two is the competence. So that is the more or less most important part when it comes to startup valuation. Having said that, you will ask me questions, certainly, that there are so many startups valued at what, and every year they are multiplying 3 times, 4 times, 7 times, becoming a 25 billion valuation in what period that our Flipkart of the world is. So how does that happen? So answer is that from the second onwards or third round onwards, the valuation is never a problem. Because then that is more like a Swayamvar which keeps happening, a fashion parade of the investors which keep happening if you are growing and you are actually growing with a substance. But the big criticality is in the initial stages. So when it comes to friends, family, for example, investing, there is nothing, no even discussion of a valuation in most of the times. Okay, this fellow has some idea, he has the passion, and let us invest in him, I'll give him some money. The second stage is the most critical one, which is the angel investor coming in, or the seed stage, because sometimes of course friend family do not come straight, angel comes in. Sometimes the early stage growth also comes sooner if the founders are well positioned to bring it to a level, or they have the background of doing the business that they are now trying to innovate and do it differently. So that is the stage where the most difficult thing is, how do I value a particular company when I am at the early stage or a angel stage, not even the round one or a series A. And that is where what happens, of course, the investors like Dharmesh bhai, who would have invested several, he would have some idea about what is the expectation. And this is also a method only. A VC typically says that I want a 20x valuation over the period of 6 to 8 years, say. And VC would say, this is the market, this is the competence, and I see the valuation going up to, say, argument, say 200 million. That means I can value the company today at 10 million because I want 20x value. So now this is a totally a different methodology. When there is nothing, no method, I want something and today I'm here, it should be 20x, so I value you at 10 million. But that also comes from the same, either you call it a scoreboard or the competence or the team. There would be transaction multiple, which everybody tries to see that the other company of a similar nature was valued with a similar team, with a similar market. The product will not be similar generally in a startup. There would be new idea, because that is why it's attracted. And in that case, some people try to apply transaction multiple, but that is not the ideal way to doing it when it comes at a startup stage. So what I recommend, and which I have seen in several investments that have happened, that let the initial angel investment stage startup not be valued at all. The valuation is as simple, that is series A, whenever it happens, at whatever valuation it happens, I will discount you at X percentage. So series A happens after 18 months. If you succeed and if you survive up to that 18 months, then if it is happening at, say, argument, say 100 crores or 50 crores or even 10 crores, I will give you 30% discount, and I will have you valued at 70 crores, your investment, with a minimum cap, with a maximum cap. So that's also what they call it a worst case scenario, normal scenario, a method. They call it a first Chicago method also in some cases, not too heard about, and a optimal scenario. And that's, but I would also want to address the series A part. The series A, which is the early stage, that we call it a valuation. That is where actually the commercialization is just beginning. The market is known, the product is known, the acceptance is more or less understood, not that there is a market, and there is a reasonability of a forecast which is possible at this stage. So first two valuations, if we call it a seed or a friend family thing, they are difficult, except some, very seasoned investor like, I would say, Dharmesh bhai, and not that they are not valued also. And then the second stage, and you do a reverse retrospective valuation. So transaction multiple at that stage is easier, because you know that market is this and the forecast is what you will see. The trading multiples are not worth comparing for startup, because trading multiples you will compare with large listed companies. How does it make sense at all? The DCF, yes, that's a discounting of the cash flow. That's a method which may be used, but only when you feel that the reasonable certainty or reasonability of the forecast which is presented. That also doesn't come at the angel investing stage at all. It comes only because you are still on a drawing board. So that's the perspective of how the valuation happen in the practice, and what methods must be used, must not be used, or how the investments may happen. It is a kind of a CCPS at the first stage, which is a compulsorily convertible instrument, which we will normally now see more than earlier. So maybe
on the same lines, Savan, this is excellent coverage of the topic here. Just can you share some insights about pre-revenue stage valuation by the startups, and as well as the enterprise value to revenue multiplier? How often it is used to determine company's valuation? One, pre-revenue stage, and contradictory, the enterprise value to revenue multiplier.
So correct. So I think we cannot say that pre-revenue stage is something where, as I said, the valuation is not visible. Not so. Again, where is the stage? And looking at the scoreboard, because I have now used that term, it's an important thing that you looking at the several facets of the business and the model and the forecast and the market and the competence. There you arrive at a stage that I have the potential to generate so much of revenue in year 1, 2, 3, 4, 5. Now that potential also comes from actual survey coming in from some market authorities. It may not be bought because the startup may not be able to afford the AC Nielsen reports, but that would be there in the public domains. There would be reports of companies doing a different activity, but which can be related to the startup that it is putting in its idea. So pre-revenue stage valuations are purely based on the forecast which the investor sees as a reasonable, achievable forecast. Forecast will necessarily be discounted because sensitivity will be there. And then at times we investors, so this is typically a discounted cash flow model. We can say I can do a 2 year down the line and then multiple, but that's not a good idea for a pre-revenue stage. So I would discount that where I feel that there is a reasonable certainty. I have the product ready, market known, and this is where I'm rolling it out from city 1 to city 2 in 3 months to city 6 in 5 months. Then and I have a plan, achievable plan, justifiable plan, ready to implement plan. And then the market, when then there's okay, I can capture 1% market over year period of time, 2% market, and that's something that assumptions, certainly underlying assumptions, and then again the gut feel of the investors, which is how the pre-revenue happens. The fun is, of course, I will not waste time, but the fun is when there is revenue but no profit, and not even the next few years that you are seeing the profits.
Absolutely.
And they are the cases which are difficult. The more the revenue, the more the losses. And then all the n number of unicorns you are seeing, that most of them, they compete in increasing their losses, is how I tell a lot of times. But then that is a revenue multiple thing, where they see that the purely the revenue multiple happens where the investor or the valuer looks at what is his market positioning. When a 51% market share is seen by Walmart in Flipkart, they will look at the market positioning. They will see 5G or 4G rolled out and 5G rolling out. And then they will see how many users are going to add. So no, don't bother about the bottom line. This market has to grow multifold. Even my 51% comes down to 41%. My absolute growth would be still year on year 40%. And then over a period of 5 years, when the market becomes mature, there would be profits coming in, because nobody is investing a continuously loss-making company. But there is no question of profits that they will make in the near future. But it is about my dominance in the market, where I'm valuing it on the basis of the revenue and the market position. So maybe I have taken one more question without your asking me.
Perfect.
But
this is the best thing when you talk to experts. They know what is the surrounding question around it, and they clarify the points around it as well. Great. I appreciate. Yeah, you were saying something.
Yeah, so I think that revenue is something which is important, where the investor looks into a depth of the market and the potential of capturing. That's just one line that I was adding.
Right. Perfect. Very nicely explained. And with regards to the startups, there are a lot of startups working in niche domain, and they are coming up with a lot of protected IPs. So in your thoughts, can you explain the benefit of protected IPs for startup valuation?
So we have one expert here. Jatin bhai, kahan khoi gaya? Okay, there's one IP lawyer that I could see initially. So yes, IP is so important. Ultimately, why startups is about the idea, about the USP. The biggest of the big companies come up with a fabulous battery for an electric vehicle, and then there's one fellow who comes in that my battery can be sustainable at a 50 degrees centigrade, and my life is so much, and I will not wear and tear, and I will make it at this cost. Now imagine that. So the batteries are there in the market. If they're running in 50 degrees also, but there is this USP. Now that is the huge value which the USP carries. If USP is convertible into market, convertible into revenue, convertible into profits ultimately. So IPs are so very important because that is where the valuation is. And of course, if you ask me that if some of the companies have the IPs already, which are in place, filed, and they are either granted or about to be granted the patents also, or for the product that they have, where they can certainly defend any of the infringement happening on the IPs, then that has an additional. So I would add to this again the scorecard. Again, I will use scorecard probably in every question. That one more item in the scorecard is my IP. And I may put a higher weightage on the IP also if I see that his IP will help me get into the market where the other fellows will not be able to push or put the product that I am putting in. And then again, that is not the sole item in the scorecard. There would be again 5 things: what is the competence and the market, and etc. And commercial viability of the product also that time. So answer is that IPs will certainly impact the revenue in the long term, because you impact in terms of benefiting the revenues will be. The profitability generally in an IP driven product is higher than a generic product. We have seen a brand versus a non-brand, as simple as that. Why are the brands valued at maybe 7, 8, 10, 12 times depending on what the product is, versus a typical generic valued at maybe 2, 3, 4 times. So that's the huge difference. And that is where the IPs play a big role in valuation. And there is an additional weight which is given to the IPs, and which may be over and above 100%. So I valued a company based on a scorecard, and then I will say, okay, you have an IP, I would put another 30% to top up the valuation, and now I will value and give you an offer of 140%, which otherwise I would have given as 100%.
Perfect. So it creates a USP as well for the startup.
Precisely, yeah. And
we have seen that the value is largely dictated by the market forces in the industry. And during these pandemic days, which have prevailed over the last 1 year, we have seen a lot of ups and downs, and we also have experienced certain unicorns coming out of India and some soonicorns in the making. Okay. And a lot of market situation govern the startup valuation. So as per you, how does an investor value an early stage startup, both in based on the product based evaluation as well as the services industry?
So good. So I relate this question along with the COVID and uncertainties maybe. So uncertainties are the best times to assess the opportunities. Now uncertainties create the opportunities when it is where you have to search for the simple reason. I was recently discussing with one Singapore-based company. They are into a very large-scale service business, and then they are right now raising money only for survival for 2 years. I said, what would you do with my money? And how are you valued? He says, I want to survive for 2 years because I am among the affected industries of COVID. I want to survive. I said, why should I give you any rupee for survival as a valuation? It should be at the cost. Bring me hard assets and then I will value you. They said that if I survive, there are 30 of us, other companies, which are maybe smaller and bigger than me. They would have difficulties surviving if they cannot raise money. And if I survive tomorrow, the opportunities, today my market share is 17 or 18%, I will make it straight away 30% because a lot of my competitors will be out of business. So the big opportunity in an uncertain business, in a badly affected business is also, and that gentleman this is a real example I'm giving you, he's claiming 6 times multiple in the times. And he's raised, this is a startup by the way, he's raising only $2.5 million. And he has already raised $1.5 million in this sense, which he clearly says that this is my plan to survive 2 years. My losses are what I'm trying to capture. And my losses will then convert into the next Series B round. Series B would be at a valuation higher, which would be a 25 million start. So one is the COVID uncertainties. Yes, you will have to look at, because industries are not going to die, right? Whether it is whichever tourism or whether it is travel or any industries which were, so they are all supposed to be, only thing is the players will reduce in the process. I would relate it to a similar thing. Somebody came up with an innovation in ink, but still ink was a chemical, and which was a bad polluting chemical that they were manufacturing. I said, you are putting up a project of a new type of bad chemicals that you're using. You will be polluting, environment unfriendly. Who will invest in you? So the fellow says, nobody is putting up this kind of plant. I am the only one. I will sell every product. I have market and I have the buyers right away before even I have the plant in place for the whole capacity. So there are investors, because investors are looking at, but there are now investors who have also become very, eco-friendly, and they will not want to invest in a otherwise than an eco-friendly also. But then you will find such guys also. So uncertainties and opportunities also go hand in hand. That's what I would say as a COVID. And you asked one more question, product and service.
Right.
Right. So Nikhil, you said you are a chartered accountant, right?
Right.
Where did you get into the software guys? So this is all software guys language, product and service. And I don't still understand what product and what service. Let me ask one of the software guys on the, on this 98 people on the call.
Can I answer that?
Yes.
I run a software services company.
So you are the right person. So Nitin, I am asking you a question here, that a client of mine wants me to develop a software for them. Is this a service or a product?
It's a product for them, but a service for me.
Yeah, no. So now, as a chartered accountant, let me flavor the question. Is this GST-able as a service or GST-able as a product? Because goods are differently taxed in terms of due date versus a service. So is it a good?
Yeah, I get your point here. It depends on the perception and the end use of the product or what we are going to deliver.
Correct. So a development, if I'll put it differently, and then I will answer the question. I'm going to a construction company who is in halfway constructing a building and telling, I want to book a house on the 11th floor. Is that a product or a service? There's GST to baju mein rakho, because immovable GST is not applicable. Is he giving me a service or is he selling me a house? So till the time it is complete, it is a service. Once it is ready, it becomes a product. A software, if I'm developing for you, especially for you, becomes a service. But if end of the software, I say, now I'm going to give you is only a license, it becomes a product. Right, a product. And so this is something, of course, the SaaS is the new way. It is only about the revenue stream and a business model. Let me tell you, I sell a license or I give a software free and then say that I will now charge you on pay-per-use basis. It may become even a pay-per-use becomes a product at times. It is just a revenue model. I give you a license and say, okay, I'm not going to charge. GE sells the aircraft engines on pay-per-use. It is a service. The whole of the aircraft engine running into millions of dollars is fitted into an aircraft where they say no charge. You use it one mile and I will charge you 1 mile. And I will give you service wherever the aircraft is. So product and service, it doesn't, my purpose of giving this explanation is purely from a valuation point of view. That a valuation will not change whether I call it a product, I call it a service. It is about my business model. Everybody says that if I create a software as a service, then a service will continue to give me revenues over a period of time, and so I will be valued higher. Answer is sorry, no, that is not the case. I sell it, make money, and keep on selling products. I keep making a tally will not be sold cheaper than somebody who is giving a service.
So it was just to give an idea to the viewers here that it doesn't matter which product or service line you are. You should be sellable and investable. So that's really
the ultimate test of valuation is growth. If there is no growth, nobody is investing in you. If you can establish there is a growth and a long-term growth, that means there is a potential not only in the market, but in your product and your competence to deliver, whether you put it as a service or you put it as a product, it will, the valuations are not going to change, because then the long-term stream will be seen. If it
perfect, Savan. Perfect. I really appreciate all the insights you shared. We have another expert, Kaushal, with us. So we would interact with Kaushal through Swati. Over to you, Swati. Thank you so much, Savan.
Pleasure, sir.
Thank you, Dr. Savan. I'm sure your key pointers on the process of evaluation will help all the entrepreneurs here in understanding the minute details of this complex process. Thank you, Mr. Nitin, also for a lovely session. Now, I would like to request Ms. Ranjana Singhal to please say a few words and then initiate the discussion with Mr. Kaushal Mehta.
Good evening, everyone. First of all, I must say, Mr. Savan, are really good, and what a great insight today. I'm sure people, those who are online today, going to take a lot of takeaway from today's session. Lot of clarity. Thank you very much, Mr. Savan. Good evening, Mr. Kaushal. There are a couple of questions which I'm going to ask. My first question to you is, as a founder, what was your experience of valuation of your organization?
So, okay, I'll be the least technical of all here because all I've done is focus on building the organization. And I believe valuation, you don't chase valuation, it follows. So 20 years back, when we started the organization, essentially we raised our Series A. And at that time, if you look at how did we value, it was pretty much, I did not attend these sessions before doing it, but there was an investor who said, look, I'll give you 600,000 and take 60% of your company. I went to someone, he said, look, I'll give you $1 million and, I'll take 80, you take 20. And then a friend of mine said, look, why are you talking to one or two people? Take money from a lot of people so that no one is in more of a controlling situation. So I talked to a lot of friends, colleagues. We spent 10 years in the US, and a lot of them said, look, if you are doing something, we will invest in you. So apparently we raised $4 million. This is at the height of the dot-com bust in an IT services idea. So now that we had the money, how much equity should be given to us and how much equity should be given to the investors? And at that time, the investors said, look, we would like 50% so that we think we are controlling. So I said, okay. So basically they took 55% and therefore it translated into a valuation of $7.2 million. So if you are raising X amount of money and then people want a particular stake, if you do the arithmetic, you get the valuation. And that was as simple as what we did. But this time around, we actually went through a process. And that process was working through actually 2-3 bankers because, during our evolution, we always had offers of people wanting to invest. But we never diluted the Series A for 17 years. We remained profitable every single year. And we basically, when we went to market, the idea was that here is a debt-free company which has 5 times the cash that it had when it had started. And there were marquee clients. So 90% of our revenue today also comes from global large corporations. 50% of the revenue comes from clients who have been with us for 18 years or longer. Right. So what were the basis of valuation? There were a lot of people who were interested, and we talked to a few, as I said, during one such valuation, and Savan is certainly aware of that. We backed a big contract, and we said, look, we believe our valuation is 50% higher because this is the revenue and EBITDA of the company. And at that time, that person said, look, we believe that is just too much of a jump that you are asking. You are asking for a 50% increase in the valuation. And so we said, look, we think we will be able to deliver. So then we kind of parted, and then we continued out. The number one thing that I want to say is that valuations are done when people invest in people. So if you talk to 2 of my 3 board members, they will say that we only invest in people, and you've heard this so many times, but my encouragement to all of you is that go past the number crunchers, and I have no disrespect to them, but who is the person writing the check, and are you able to connect with that person? Do they see value in you? And so for this time, we had a large private equity folks interested in us. We had a large public company in the US, been around 30 years, also interested in us. and that's whom we ultimately merged with. Now, right after the first call with the banker, I said, look, I would not like to continue until I can talk to the founder and chairman of this company. So when those series of meetings started, that is when they decided that this is the chemistry fit here, the values and the synergy of the organization. So it may seem numbers, but end of the day, the person, when they made a decision, it was that they are a public company. They know what their market multiple was. Anything below that is going to give them a fillip the next day over. So let's say if they are trading at, make it a number, 15 times EBITDA multiple, and anything less than that, we become part of them, that's the premium they will get. So that was out of the question, but what did they value? So number one, the people and the management team, that this was a values-based company with corporate governance. Now, these foreign investors, PEs, there is so much of sensitivity, and that doesn't come up in all of this, that when they ultimately write a check, where is that comfort level? And that is in the corporate governance. We had at a peak 85 people in a diligence team looking at us from every aspect of the company: HR, labor, IT, security, client contracts. And the idea is, maybe this is from someone who's making an investment, they'll give you a number and they will say, look, A, B, and C are not right, so that is why we will reduce you. But you're already in the process with them. So, it's difficult to get out. So I said, look, let's agree on a number. I will not reduce $1 after that, because I believe we've built a good brand here with good clients, and you can do all the diligence you want. It happened that after a period of time with all these guys, they did not really come up with anything material, but they said, here are 3 points. And we said, yeah, they could be points according to you, but we are not going to reduce. So valuation also is about your strength and your leverage, how confident you are in your business. It is all a relative thing. If I am confident about my business, then I can expect a certain valuation. But it is not that rocket science. When we look at these large numbers these days, it is not that I can do some magic over a person and they will give me 5 times the market. So we got valued at 25% premium to the market after the new number that I talked about, which I discussed earlier with Savan Bhai as an example. So there were a couple of people wanting to do that. Now here is our story. So we said, look, this is good. Original offer 2-3, we got 50% higher. Now we are getting a 25% premium on that. So we've come a long way from this organization, maybe a year, 18 months back. Now, what do we think about this? And we said we could actually do better. Now you can't go and keep saying increase the number. So here is the skin in the game. There were 2 parts in the investment. One was our Series A investors, and the Dhrubai, if you want to listen. Basically, essentially, they were the Series A investors who had invested in us, and they had been with us for a long time, patiently saying, we do not want to exit. So finally, when they agreed, they got an 11x return on their original investment. So they were, delighted that this was a terrific return, that 10x magic number, this got crossed. We had 22.5% of equity in employee stock options. We believe that is the highest employee ownership of any company across any sector in the country of India, and the highest employee ownership of any BPO, contact center, KPO company in the world. So we said, look, employees have been with us for a long time. Maybe we provide them liquidity because, all of them are ready to buy their first 2-bedroom apartment or 3-bedroom apartment or a house, maybe make down payments with this money, and created widespread wealth. But then we looked at ourselves and we said, we have a house and 2 cars, and we think our valuation is higher. So, we told the buyer that, look, we had stock options as employees also, because we are, employees in the company. So we got some liquidity. The first round valuation, I forgot to say, Parul and I, my wife and I, who built the company, we also are Series A investors. So we put in money at the Series A round, again, to show skin in the game, the discussions really stop, when they say, look, here they are acting as series, and of course we put 5% money, they put 95% of the money, the 7 different people. But that showed commitment. So now when we look at this, we said, we believe the company is going to grow. Why don't you look at exiting our investors who've been with us and very loyal, our employees who are young and have a lot of life ahead of them, and we will continue with the company. Most people certified me as pretty much eccentric. They said, you worked all your life and you are risking almost 80% of your upside, because we got some liquidity, 10-15% in the first round, which we thought was enough to take care of our expenses. Why are you doing this? And we said, because we believe there is value in the company. But more importantly, we wanted to leave a legacy that when we leave, at some point, then the organization continues and there is an amazing synergy of values. So 3 years later, this company doubled in revenue. And 3 years are just completed this particular year. And the EBITDA grew just under 300%. And EBITDA is generally a metric of measurement in our industry. So now you talk about which numbers and which principles to follow. Do you trust yourself? Are you willing to go the long term? Or are you looking at 1 or 2 years? After 17 years, we are ready to do another 3 because we believed in what we wanted to do. So my story is, a little different from, the today's industries and all. But if you look at the parameters, there are not a whole lot. It is governance. It is your values. It is your clients. It is your buyer what is his ability here, their ability to pay, and what are you feeling? They did not have an India presence. They were trying to get into India. They got in India 10 years back and, had a lot of difficulty. They exited. So they said, can we trust this person? And if that answer was yes, they were going to jump in India. So there was value synergy, there was sales synergy and client synergy. We had, as I said, 90% brand logos. They are several times bigger, but their logos were different than ours. So it added to their logos. And cost synergies. I operated my business by being the chief salesperson, if you will, by going and talking to my contacts and the references and conferences and all, and did not invest in a large sales team. Well, these guys had a large sales team. So when they were doing a combination, there was not a lot of fluff in the system, which means that they were getting pure value. This was a company that was filling a need for them. And that's really how that happened. So I hope I answered somewhere the question that you asked.
Absolutely, Mr. Kaushal. In fact, I feel the audience must have understood very well by listening to your real life story. And I completely resonate with you when you talk about people. So we talk about people-driven, process-driven, number-driven companies, but nothing like investing into people. And that's the whole value about the startup and the business, which goes a long way. Thank you very much for that. There's another question which I thought I'll ask you is, what are the common errors a founder makes during valuation?
So, this question comes, and as I said, guys, there are really no errors, because don't get hung up on valuation. And here is an example. When I go and talk to people, Mr. Narayan Murthy can say, I made an error when I went public. I should have gotten 2% more, which means each founder 2% more. So maybe 5-10% more. Then he would have become richer by 2%. Does it matter to anyone that he would have been richer by 2%? But guess what? He made an error and took 2% less. So he would have been poorer by 2% of his net value. Is that relevant? So if you are trying to build something of value, then it is not about valuation. You create a big enough pie. Our satisfaction is that we created 300 millionaires in the rupee, pesos, or the dollar. Few employees are even in dollars who made that much money. And that was the wealth creation. An employee who had really a tin roof in the Philippines built a house, and that house is a one-room house, not a one-bedroom house, but it's a one room. And on that house, they put the logo of our company, Motif. And there is no logo of that company today on anywhere on the planet, because now we are TTEC. So, when we talk about these errors, I don't think any of you as entrepreneurs should take to heart that this guy schemed me and got 2% more, or maybe 2% chala gaya, 5 chala gaya. It is not that. It is about life at a longer term. So this is what people invest in. This is how you invest in. Can I trust this person for the next 5 to 10 years? That is how clients give business. And so get out of this notion that I made an error. And I gave you the example of the topmost guy, my personal role model, who gave out stock options very early in the industry. And one can say he made an error of 2% either way or this way, and it is immaterial to the entire world. But he is the guy who created the wealthiest Indians, because a lot of wealth creation was done by Infosys. And for that, he is remembered. So that's how I would answer if it's not a direct answer. But
I hope those who believe in people-driven companies, I would say those who invest in value of the companies will completely resonate with you. What are the key points to keep in mind during valuation? We are just repeating your answering many times, but just to sum it up, what do you think, what to keep in mind during valuation?
Yeah, so a couple of things. See, and what I'm saying is that it is not that when valuation happens, you start thinking about this. Corporate governance, for example, when I said, you have to run your company, and prior to that, your life. Let me start with that. And maybe this may become too philosophical for a business community. But we worked in the US for 10 years. My wife and I, at Intel, she was at Intel, I was at Sun Microsystems. We decided to come back to India. We started a software company. Saurabh was the first person I met. Then I came back. And then we started this BPO company in the year 2000. So we went to our colleagues, ex-colleagues at Sun and Intel, and 5 of them said, look, if you are doing something, we'll give you $1 million. Now tell me, what was the factors that I was keeping in mind? When we say governance, it is how you have conducted yourself throughout your life. For the 10 years they knew us as colleagues and as friends or acquaintances, they said, look, I can trust this person with my money. And that is really how it happened. But as we go along, what do you keep in mind? You keep in mind what is going on in industry. I'm not saying go blind. Anyone says any number you accept. So you have to know your net worth. And what I'm actually saying is that we thought our net worth was probably 25% premium than the market. At one point, we thought it was 50% higher than what they were offering. And then we thought it was double than what they were offering. So you need to know your net worth, but keeping in mind that end of the day, it is not about how valuable I am. Am I able to deliver? So when we offered that proposition to this buyer, they said, look, here is someone who's selling their company, but actually not selling their stake, keeping majority of it. What better commitment can I have? And now they have the majority. So if this company grows, we are gaining more than the founders themselves. So how could this be a bad deal? All of a sudden, all the barriers went away. But the thing in mind is essentially that, are you wanting to stay committed and deliver? And the way you conduct yourself in the company. So if that answers, I know there was some repetition there, but.
Yeah, I was just wondering from my side, I wanted to check, though we are running out of time now, very briefly. What happens when you leave the control of your company, like what you said, 50%, 55% stake given to investors? Do you think the founder's vision gets diluted? Can we work together as team then? Does it happen?
Yeah, so that's a great question. And again, this is when, if you are focused on your people. Now, people, the theoretical knowledge is that if you have been an entrepreneur for 20 years, you can never work for anyone, right? So our story, 17 years, Motif, prior to that, a software company for under 3 years. How did that happen? We are in our 4th year with this global company. So you don't have to carry your egos around. And again, I don't mean a negative way. If you are running your own show, then you think you know it all. And all of a sudden there are systems and processes in this company. One thing I learned actually was that financial governance, where I had made mistake, the controls that they had in place, the reporting that they had in place in financials, my guys took 30 days to produce financials because there was always some depreciation schedule to be done, and we could not get our financials published with sophisticated finance. So I learned that. But what were Parul and I focused on? We were focused on that our leadership team who has been with us. So for us, 1 out of every 7 employees has a tenure of 5 to 20 years with the company. 1 out of every 20 has a tenure of 10 to 20 years with the company. We're talking about an IT services company. So that's the leadership domain here, a leadership team here. And in this big global company, can they become future leaders? It is not about us selling valuation and going home. It is about TTEC India now. Our TTEC India leaders taking on leadership roles, and we've had those success stories. They are managing clients for TTEC globally. They're managing roles for TTEC now in the Philippines. One is reporting into the US analytics and reporting team. So that was our focus. That is my team getting integrated, and will this outlive us for the next 20 years? If that happens, then you don't have to think about how to take orders. You understand that this is the company, there is a process. And by the way, I was lucky that our head of APAC, who I reported to, was a gentleman who was very supportive of any time I challenged the status quo, saying, look, this is a good point, let me take it up, and we were able to resolve. So that only helped. But the idea is that it is not the same way. I was taking, for the last 3 contracts, guys, I look at a contract and I sign in DocuSign. The legal head of TTEC said, Kaushal, when a law contract comes to you, please forward it to us because we have a review process. We review, then you sign. And the next contract comes and I sign. Because a contract comes, I think it's okay, I sign. That's how I was programmed. It took me 3 attempts to get it right, that no, in a big company, lawyers have to, and of course, these are all vetted, but they want to take a final view that before coming into DocuSign, has something changed? That's a level of governance. And I always trusted my clients that once it's finalized, it comes in DocuSign, you sign. So there were learnings all along the way, but we were thinking, hey, look, Parul is leading. There are 12 people in the Global Diversity Council at TTEC. Out of 54,000 employees, Parul is one of them. Leading the India initiative as a female, but as a senior, VP in the company of a global public listed company. Now that's the growth. That's the opportunity and the exposure. So you can take it either ways, and absolutely you can do it. Not 1, 2, 3, 4 years as well.
Thanks.
Renaji, can I ask one question to Kaushalji?
Yeah.
Small question. Kaushalji, how much do you think is good to have ESG? Since you are a US-based company, right? ESG means environment, social cause, and the governance. How much importance that you need to give it, especially in case when a startup guys comes to you for an investment?
Yeah, so that's a great question. I know I talk a lot, so I don't know if we will do justice in the time. But so essentially, 4 stakeholders, your customers, your employees, your investors, and the society. That's how we build our mission, long-term value creation. For our customers, we delivered value. For employees, we delivered the wealth creation and the growth. For our investors, we delivered the 11.2x return. But for the society, even before CSR was started, for the 19 past years, we are running our annual charity walks. And we've had 85,000 people walk so far, and we've raised 9 crores for 62 different charities. Now that charity walk is not just a walk. By the way, it's local, so we don't get any customers from it, or we don't get any other leverage. But what we get is the pride of association of our employees, that I work for that company that does the charity walk. And that has also been very important. We were ranked by the governor of Gujarat as the one of the highest corporate blood donor in the state. And we do those drives every year in the company. So there were certain initiatives like the charity walk, like the blood donation, which we have done. GIZIA, our Gujarat State IT Association, ranked us at the top CSR company 4 years in a row. So I believe that value creation and decisions are made by all stakeholders, or keeping in mind all stakeholders, your customers, your employees, your investors, and the society. And if you take decisions to that regard, then it is okay. So now I went, and one of my employees said, I want to start a company. I said, great, I'll advise you. And then I said, look, what stock option pool are you going to keep aside for employees? We have kept 22.5%. So he hesitated. I said, start with 10%. He said, look, let me start the company. 1-2 saal ke baad main kuch karunga. So the day the employees gave us our stake, on day 0, we split that into half, and the half was put for employees. Then of course we got options, so that stock increased a bit. But the idea is that that was the commitment. And we had a contract that nobody, the investors nor the founders, can access the employee pool. So is that the passion with which you are looking at? We did, and we believe that value creation is for everyone, including the community around you.
Thank you.
Thanks, Mr. Kaushal. Actually, I completely understand when the growth is inclusive and it's not exclusive, the sky is the limit. Thank you very much for that. And time to say our sponsors. Swati, would you play a video?
Yes, ma'am, I'll just do it.
Yeah.
A team of 4 people, 2 college professors and 2 of their students, started working as a team in few government projects and other projects. After completing their degree, both the students joined in software company, and both the professors moved over to IT industry. Few years later, they strike with an idea of improving the Indian engineering education system. Once again they all joined hands together and decided to start a company on their own. Developed a learning platform that would revolutionize the way of engineering education in India. This is the start of the journey of Amphisoft and its flagship product, eBox. And our other products, T-Box, Talent Rank.
Thanks. This is Amphisoft Technologies. They are sponsored for TAI Coimbatore. Amphisoft Technologies started in 2009, is a technology company building highly scalable generic software engines which can be easily customized into platforms and products catering to different services in varied domains. Amphisoft products eBox caters to next generation education, L&D engine for skill-based and practice-oriented learning through data-driven approaches and AI-driven mentoring. So a big thank you to our sponsors, and over to you, Piyali. I think it's time to say bye to everybody, and a big thank you to speakers today from my end. It was a great insight. Thank you, Saurabh, and as well as Nitin also to be there today.
Thank you. We do have a couple of questions, but I think we're already 10 minutes past our time. Sarabhai, would you like us to probably take a couple of minutes and just see if all those have been answered already, or?
I think as long as the speakers keep it very short, we can take a couple of questions.
Probably just a couple of them. Bhavin Bhagat, Bhavin, are you still here? There is one question from Bhavin. If he's there, we can take.
Yeah.
Bhavin, please,
yes,
if you would like to ask, yes.
Okay, so question is more about, I've come across startups where they have global products, and they say that if we change our base to somewhere outside India, we will get higher valuation for the same company. So is this something you have come across, and what do you think about that? Savan bhai, you can.
Yeah, Bhavin, of course, Saurabh bhai has instructed very crisp answer. So Bhavin, thanks, and hope everything is fine. So answer is no. It is how and where you are generating. This came up very recently in one of the cases where one Italian company was investing in India. They cannot have Italian valuations if they are investing in India. If an Indian company is investing in Singapore, then they cannot have the Indian valuation happening there. A Flipkart, which is a Singapore company, has an Indian valuation. It is not a Singapore valuation. A similar e-commerce company in Singapore would be valued much lower than Flipkart, because the Singapore does not have the potential what 130 crore guys using 4G has. right? So simple answer is no. Where the business is coming from is where the valuations will come from.
Okay, thank you.
Thank you. We have, I think, 1 or 2 questions from Mr. Rajendra Siddhai. So, Mr. Rajendra, if you are here and if you would like to take up the question.
Yeah, thank
Yes,
you. So basically, we initially talked about using various parameters and to actually do a valuation. So and then one of the speakers talked about when it should be, one should be careful about how much you are diluting at what level of investment, etc. So are there any kind of indicators or some kind of thumb rules about at what numbers, like what percentage should be diluted or not diluted, etc. That's what my question was.
Dharmesh bhai, I think you have to answer this.
Okay. Rajendra ji, I think so the dilution should not be more than 20% of the by the stakeholder, by the founder at the seed level or the angel level, because then they will be able to dilute it over a period of time. So what we see it, we don't encourage people who are diluting more than 15 to 20%. So that's the number we see at the time of seed capital.
Okay, thank you.
I think PLE we are done.
Do you want to take the last one? I just wanted to check with Dhruv bhai. I saw that he had put a question. Dhruv bhai, you still have that question to be answered, or you're okay?
No, so that was just a question that when Savan bhai was telling a multiple of 6. So when I said multiple of 6 is 6 multiplied by revenues.
And so that doesn't matter whether multiple of EBITDA, multiple of revenue. It depends on, like what I was saying, when revenues are also given multiples, are the companies which are continually making losses or not the profits which otherwise they should be making. Then I do not have a choice but to use a revenue multiple. But see, the essence of the whole story is the case study of Kaushal bhai. As simple as that. Kaushal bhai's valuation was not driven by some multiples. It was driven by some several factors, and what he emphasized several times in what he said is the governance. A highly transparent, highly ethical business and inclusive, including 22.5%, imagine. And the valuation that these factors give you are much more than just multiples are when you have a similar company, similar product, similar growth rate, and then there is a transaction which is done. I will try to, but generally in the real world, multiples are a derivative of a valuation, and you ultimately to make a statement, I was sold or I bought for 6 or 12 or 15 multiple, right? Generally, a growing company, 6 is a revenue multiple, depending on a brand or non-brand or B2C to B2B. EBITDA multiples in a fast-growing companies are upwards of 15 times, 12 times, depending on what product they are. Right? That's how. So that's the point of it.
Jatin wants to ask something.
Yes, Savan bhai, though it's not relevant to the startup, but just a question to you, since it's an opportunity for me to pose direct question without approaching you professionally. I understand. Now, only the straight question to you is that in case of a litigation, because I'm sure if I named, you will recollect, but there are one corporate who is currently facing an injunction from the Supreme Court that neither of the parties, like, the party 1 and party 2 from the same family cannot use the brand. Now the question before us since this January is that the family member have realized and they started evaluating the scope of resolving the matter. And resolution is that we should pay, like we will value it and then either of the party will pay for it. Now here the interesting part is that since last 12 years, the brand is not in use, right? Because you referred that, the profit is the major, I would not say the criteria, but yes, major point where we can assess the value of the brand. Now brand is undoubtedly, it's a very big brand, have been doing phenomenally good till the time it was on a rack. But somehow due to the Supreme Court order, neither of the parties are able to use it. So this is a 12 years old story. Now the family is trying to resolve. So what is just obviously professionally is it will go longer part, but what do you think on this?
Yeah, the simple crisp answer is that is the brand still relevant? Is the brand recollect value still there? Is the competitor, are the competitors in a position where they will allow the brand to penetrate the market and come to at certain level that the business will happen? And the valuation will ultimately happen on that forecast of the possibility of reasonable certainty of that brand making a headway in the market and then getting into the market. On a long run, any business has to make money. No business will continually not making money. Any investor is going to come in. Yes, they are seeing that my appetite to invest is for 10 years. I can take a loss for 10 years. Then that's an appetite question. But no, they don't want to just create a market and lose money. So one brand position still recollect value, getting into the market, creating a the position which earlier it had or a part of it, and then over a period of time creating profits, but then the investors will value it accordingly. So this typically would be a discounting of cash flow along with a premium for a brand if the investor thinks this brand still is quite relevant and the market will absorb it. So that is how it would happen.
Thank you.
Okay, I think we are completely out of time, and I myself would have to go, and somebody else would have to take over. So I think let's. And we are completely out of time. We don't want to hold on to the speakers and everybody else. So thank you very much, the speakers. I think one thing we definitely got out of this is somebody builds an AI model on the valuation of the company. I mean, he will make a phenomenal success, and all of us would invest in that. Beyond that, we'll have to invest in people. We have to invest in governance. We have to invest in certain, methodologies of valuation, and those methodologies would depend on the sector, IT sector, pharma sector, electrical battery sector, blah, blah, blah. So at the end of the day, the valuation is just an investor's personal choice and how you are able to convince the investor of yourself, your team, your product, your solution, whatever you bring to the table, you convince the investor to make it like 10 times, 20 times, or 2 times. It's up to you directly how you do it. So that's what I got out of this thing. And I think fantastic talk by all the 3 speakers. And thank you all very much for your time and the insights which you have delivered. And I thank everybody else present here and the presidents Ranjana and Nitin for putting the session together.